Picture this. You're standing in Shanghai with a silver bar in your hand. In that moment, that same bar is worth $8 more per ounce than if you were standing in New York. $8 per ounce. This isn't a glitch in the system. This is the system breaking down in real time. On December 24, 2025, something extraordinary happened in the silver market. While most people were preparing for Christmas, traders in Shanghai watched physical silver prices explode to $78.49 per ounce on the Shanghai Gold Exchange. But here's where it gets wild. At that exact moment, COMEX silver futures in New York were trading at just $70.36. That's an $8 premium for physical metal in Asia. And that gap? That's not supposed to exist in a functioning global market. So what's really happening here? Why is the world's largest silver consumer paying prices that seem disconnected from Western markets? And more importantly, what does this mean for the future of silver? Let's break it down. To understand this crisis, you need to understand how silver markets normally work. There are essentially two silver markets: the paper market and the physical market. The paper market, dominated by exchanges like COMEX in New York and the London bullion market, trades futures contracts, options, and other derivatives. These are essentially promises to deliver silver in the future. The physical market deals with actual metal, bars, coins, and industrial inventory that can be touched, stored, and delivered immediately. For decades, these markets moved in sync. If prices diverged, arbitrage traders would step in, buying where it's cheap and selling where it's expensive until prices realigned. That's basic market mechanics. But something fundamental has changed. The Shanghai Gold Exchange facilitates direct physical trading through contracts like AgT+D. Unlike COMEX, where most contracts settle in cash or through complex exchange for physical mechanisms, Shanghai demands the real thing, deliverable metal. And right now, Shanghai is screaming for physical silver at any price. That $8 premium we're seeing isn't just a number on a screen, it's a distress signal from the physical market. It's telling us that in Asia, where most of the world's silver is consumed, there simply isn't enough metal to go around. Let me paint the full picture. The Shanghai Futures Exchange silver inventories have collapsed to levels not seen since 2015. We're talking about 531,211 kilograms as of December 2025. That might sound like a lot, but it represents a drop of over 40% from 2024 peak levels. Meanwhile, the Shanghai Gold Exchange volumes have retreated to 9-year lows. When both your inventory and your trading volume are collapsing simultaneously, that's not a market correction. That's a structural shortage. But here's where it gets even more interesting. The silver market has entered what traders call backwardation. In normal markets, future delivery contracts cost more than immediate delivery. That's because there are costs to store and ensure physical metal over time. This normal state is called contango, but backwardation flips this on its head. In backwardation, immediate delivery is more valuable than future delivery. It's the market saying, I need metal now, and I'll pay a premium to get it today, rather than wait for tomorrow. In Shanghai, near-term silver contracts are trading 3 to 5% above forward prices. Think about what that means. Traders are so desperate for immediate silver that they're willing to pay significantly more for metal today than for a promise of metal in 3 months. This is the market equivalent of paying double for overnight shipping because you absolutely need something tomorrow. And here's the kicker. This backwardation is persisting even with those $8 premiums. Even at record high prices, buyers in China still can't get enough physical silver. So what's driving this unprecedented demand? The answer lies in China's industrial transformation. China consumes over 50% of global silver production. That's not a typo. Half of all the silver mined globally ends up in Chinese factories. And that demand is accelerating, not slowing down. The solar panel industry alone is consuming approximately 140 million ounces of silver annually. Every solar panel needs silver for its photovoltaic cells. As China races to dominate renewable energy, this demand is becoming insatiable. Then there's electronics, from smartphones to electric vehicles, from 5G infrastructure to advanced semiconductors. All of it requires silver. Silver has the highest electrical conductivity of any metal. In many applications, there's simply no substitute. But here's what makes this different from past supply crunches. This isn't speculative demand. This isn't investors hoarding metal hoping prices will rise. This is industrial fabrication demand. Factories that need physical silver to manufacture actual products. You can't build a solar panel with a futures contract. You need the real metal. And that metal is disappearing from global inventories at an alarming rate. The global silver market has been in deficit for 5 consecutive years. That means every year, the world consumes more silver than it produces. The Silver Institute projects a deficit of approximately 149 million ounces in 2025. Year after year, we're drawing down the stockpiles. And unlike oil, where you can drill more wells when prices rise, silver supply is largely inflexible. About 70% of newly mined silver comes as a byproduct of mining other metals like copper, zinc, and gold. That means even if silver prices double, you can't just mine more silver. Production is tied to the economics of those other metals. New silver mines take 5 to 10 years to bring online. Existing mines are already operating at capacity. There's no cavalry coming to save the day with a flood of new supply. This is a structural problem, not a temporary squeeze. Now, here's where the Shanghai situation gets really interesting. Those elevated premiums are creating what should be an arbitrage opportunity. In theory, traders should buy silver in New York at $70, ship it to Shanghai, and sell it at $78, pocketing the difference. But that's not happening at scale. Why not? First, there are China's export controls. The Chinese government has been increasingly restrictive about silver exports, viewing the metal as strategically important for its industrial policy. In October 2025, China exported 660 tons of silver to London in an attempt to stabilize global markets. But that was an exception, not the rule. China is generally keeping silver within its borders. Second, even if you could navigate the regulatory hurdles, physical silver can't be moved instantaneously. It takes weeks to ship metal across oceans, arrange storage, get regulatory approvals, and complete delivery. By the time your silver arrives in Shanghai, the premium might have changed dramatically. Third, and perhaps most importantly, there's a growing sense that holders of physical silver don't want to sell. Why would you sell your metal to capture an $8 premium when the market structure suggests prices could go much higher? This is classic hoarding behavior, and it's exactly what happens when markets sense a real shortage. Let me tell you about another signal that's flashing red. Silver lease rates. These are the rates at which holders of physical silver will lend their metal to others. Think of it like interest rates for borrowing silver. Normally, these rates are quite low, but they've surged to record levels. Why would lease rates spike? Because people in institutions who have physical silver are increasingly unwilling to lend it out. They want to hold on to their metal. And when borrowing costs spike, it means physical silver has become precious in the most literal sense. Here's something that should concern every investor. The disconnect between paper and physical markets might be more severe than these premiums suggest. COMEX has massive open interest in silver futures, hundreds of thousands of contracts representing billions of ounces of silver. But the actual physical silver available for delivery, that's a tiny fraction of the paper claims. It's estimated that there might be 100 or more paper claims for every ounce of physical silver actually in COMEX vaults. For decades, this system worked because most futures contracts settle in cash, not metal. Traders close their positions before delivery, or roll them forward, or accept cash settlement. The physical metal rarely moves. But what happens if more traders start demanding actual delivery? What happens if the Shanghai situation spreads and more markets demand physical settlement? This is where the system could face a real reckoning. If even a small percentage of paper silver holders demand physical delivery, there simply isn't enough metal to go around. The Chinese market might be giving us a preview of what happens when paper promises meet physical reality. We've seen this movie before in other markets. In late 2021, nickel markets faced a similar crisis. In March 2022, the London Metal Exchange had to halt nickel trading and cancel trades when prices went parabolic because physical delivery became impossible. The market broke. The difference with silver is the scale. Silver underpins critical industries, renewable energy, electronics, medical applications, water purification. This isn't a speculative asset. It's an industrial necessity. A breakdown in silver markets wouldn't just hurt traders. It could disrupt global supply chains. So what comes next? Several scenarios are possible. In the optimistic scenario, these high prices eventually incentivize enough new supply and recycling to bring markets back into balance. Industrial users find ways to use less silver or develop substitutes. The premiums normalize and life goes on. But there's a more disruptive scenario gaining credibility among analysts. If China's industrial demand continues accelerating, if solar panel production keeps ramping up, if global inventories keep falling, we could see sustained backwardation and even higher premiums. Some analysts are now openly discussing the possibility of silver reaching $100 per ounce or higher in 2026, not through speculation or hype, but through genuine supply-demand fundamentals. When the world's largest consumer is paying $8 over Western prices and still can't get enough metal, that tells you something profound about market dynamics. There's also a geopolitical dimension to consider. China's control over silver consumption gives it significant leverage over global markets. As tensions between China and the West continue, silver could become increasingly weaponized. Export restrictions, strategic stockpiling, preference for domestic consumption, all of these could further tighten global supply. Some analysts believe China has been accumulating undisclosed silver reserves while simultaneously supplying Western industrial demand. If true, China could cut off or significantly reduce exports at any time, creating instant chaos in Western markets. For investors watching this unfold, the Shanghai situation raises critical questions. Is this the canary in the coal mine for broader silver markets? Are Western paper prices artificially suppressed, disconnected from physical reality? Will other markets follow Shanghai into backwardation? The answers to these questions could reshape the precious metals landscape. If you're holding physical silver, actual bars and coins, you're suddenly in a very different position than someone holding paper silver through ETFs or futures contracts. The Shanghai premium suggests that physical possession has real quantifiable value above paper claims. For industrial users, this situation is even more pressing. If you're a solar panel manufacturer or electronics company that needs silver, you can't afford to wait for markets to stabilize. You need to secure physical supply now at whatever price. This creates a self-reinforcing cycle. Shortage fears drive buying, buying drives inventory drawdowns, drawdowns drive higher premiums drive more shortage fears. Breaking this cycle requires either a major supply increase or a demand decrease. Neither seems likely in the near term. Looking at the technical indicators, the silver market is displaying classic shortage patterns across multiple metrics: backwardation, elevated lease rates, premium expansion, inventory depletion, rising volatility. These aren't isolated signals. They're all pointing in the same direction. Meanwhile, the fundamentals support higher prices. The green energy transition is real and accelerating. Electric vehicles are becoming mainstream. Solar panel installations are breaking records. 5G networks are expanding globally. Every one of these trends requires more silver. On the supply side, mining faces increasing challenges: environmental regulations, permitting delays, rising costs, depletion of high-grade ores. Even with strong price signals, bringing new supply online takes years. And remember, most silver is a byproduct. Primary silver miners are relatively rare. The supply response to high prices will be muted compared to other commodities. Here's what makes this moment so fascinating from a market structure perspective. We're witnessing in real time what happens when a critical commodity faces genuine physical constraints. The Shanghai premium is not caused by manipulation or speculation. It's caused by factories that need metal to operate and can't get it at any reasonable price. This is economics in its purest form. Scarcity driving price, markets clearing at higher levels, physical reality overriding paper contracts. The question isn't whether silver will remain elevated. The question is how high it needs to go to actually balance supply and demand. At $78 in Shanghai, factories are still buying. At $80, $90, $100? Where does industrial demand finally slow enough to meet available supply? For context, silver averaged around $24 per ounce in 2023. The current prices represent more than a 3 times increase in just 2 years. Yet inventories continue falling. Premiums keep expanding. Backwardation persists. This suggests we may not be near equilibrium yet. One more crucial point about the Shanghai situation: it's exposing the fragility of global metal markets. For decades, we've operated under the assumption that metals like silver were fungible global commodities. A bar in New York was worth the same as a bar in Shanghai because arbitrage kept prices aligned. But that assumption breaks down when physical delivery becomes constrained. Geography matters. Regulatory jurisdictions matter. Possession matters. We're moving from a globalized commodity market to increasingly regionalized ones, where location and physical access create real, persistent price differentials. This has implications far beyond silver. If the same dynamics play out in copper, nickel, lithium, or rare earths, all critical for the energy transition, we could see a fundamental restructuring of global commodity markets. The Shanghai silver premium might be a warning shot across the bow of the entire commodities complex. So what should you take away from all this? First, understand that this isn't just another price spike. The market structure changes we're seeing, the backwardation, premium expansion, inventory depletion, suggest something more fundamental is shifting. Second, recognize the distinction between paper and physical markets. That distinction is becoming increasingly important. The Shanghai situation shows that physical possession has tangible value that paper contracts may not capture. Third, pay attention to industrial demand drivers. The green energy transition isn't slowing down. If anything, it's accelerating. That means sustained structural demand for silver and other critical metals. Fourth, watch how other markets respond. If Shanghai's premiums persist or expand, expect other regions to follow. The arbitrage mechanisms that kept global prices aligned may be breaking down. Finally, understand that supply responses take time. Even if silver hits $100 or higher, new mines won't materialize overnight. The supply-demand imbalance could persist for years. The Shanghai silver situation is more than a market anomaly. It's a window into the future of commodity markets in a world of energy transition, geopolitical competition, and physical constraints. The $8 premium we're seeing today could be just the beginning of a broader repricing of physical commodities against paper claims. Whether you're an investor, industrial user, or just someone trying to understand global markets, the message from Shanghai is clear. Physical reality eventually asserts itself. Paper markets can deviate from fundamentals for a while, but not forever. And when the correction comes, it can be swift and dramatic. That's the real story behind the Shanghai silver spike. It's not about traders making profits on arbitrage. It's about a global market confronting genuine physical scarcity for the first time in generations. And the outcome of that confrontation will shape commodity markets for years to come. Keep watching Shanghai. The premium might fluctuate day to day, but the underlying shortage isn't going away anytime soon. And every day that premium persists, it's telling us something important about the future of silver and the metals markets that underpin our modern economy. What happens next? That's the question every trader, investor, and industrial user is asking. Will Western prices eventually catch up to Shanghai? Will Shanghai premiums fade as supply improves? Or are we entering a new era where physical and paper markets remain persistently disconnected? The answer will emerge over the coming months. But one thing is certain, the silver market just sent a powerful signal, and smart money is paying very close attention. Thanks for watching. If you found this analysis valuable, hit that subscribe button and ring the notification bell so you don't miss future updates on this developing story. The silver market is evolving rapidly, and we'll be tracking every major move. Drop a comment below. Do you think silver is heading to $100? Are you buying physical metal or staying with paper? Let's discuss. Until next time, stay.